And for more, let's bring in Santosh Rao, Head of Research at Manhattan Venture Partners. Santosh, thanks for your time today. Let's start with Alphabet's earnings. Investors not too happy. We saw shares down in after-hours trade. But for you, what was your biggest takeaway from what we got from the Google parent?
I think what's happening is a theme. It was a good quarter, actually, but it's all about spending. They're just spending a lot. The market is concerned that all of these companies are spending so much. They need to see ROI on all the spending, and it's going to take some time. So in Amazon's case, they are very well positioned. They have multiple levers they can pull. So I'm not worried about Amazon. It's a knee-jerk reaction. Let it pull back a little bit. That's fine. And the whole market is coming down. So the gravity is pulling everything down, but that's okay. The fundamental story of Amazon, it's a very diversified company, very well positioned in the AI space. So I'm not worried. I think AI will do well. But the spending, you have to bear with it. It's a long-term story. Don't get jinxed by it. It'll pay off down the road, but they have to spend now. If not, they're going to fall behind. So expect more and more spending, but look at the long term. Are they spending on the right things or not? And which they are. So I think I'm not worried.
Yeah, so that's the view for Alphabet. Let's take a look at the other earnings that you got. Oh, that we have AMD, Qualcomm giving lackluster sales forecasts. ARM's holdings, that's disappointing with a miss in licensing revenues. And you can see investor sentiment in those stocks really push them down. So is the AI trade running out of steam now?
Yes, I think the path of least resistance is down. So all the stocks are getting hit across the board. But you really have to look deeper. AMD, they had record revenues. Everything was good. But it's all about the future. They feel that they're slow. They need to ramp up. The market is not very confident about their ability to execute and compete in the future. And that's what's happening, even though they had a good quarter. And the other, Qualcomm, it's all about the shortage of memory chips. So these are like very technical factors, not very fundamental stories, but there are chip shortages, memory shortages really affects the whole supply chain and the demand side. So I think that's affecting there. And like you said, with the ARM holdings, it's about the licensing revenue and all that. So these are like, okay, they're missing here and there, but in a market that was so heavily priced, or rather priced for perfection, any type of missing on any kind, on sales, revenue, outlook, you're going to get punished. And that's what's happening. You had a good ride, all the companies had a good ride, but I think now they have to prove, they have to show the market is getting jittery about their spending, and they have to be perfect. So they were priced for perfection, and that's what you're seeing. Any hiccup, you're going to get punished.
Yeah, so that's the valuation side, Santosh. The other side, too, is the concerns over AI disruption, particularly in software plays. We see that with the latest Claude version from Anthropic, really putting questions over whether we really need these software companies as much as we've had before. So how should investors balance looking at AI as a threat rather than a growth catalyst?
Yes, AI is definitely a threat if you look at it at the surface level, but software is not going away. What's really impacted is the rate of growth is going to slow down because now you have a new game in town, and AI is going to really disrupt, especially a number of verticals like the data aggregators and all the other stuff that can be done easily. The coding guys, then the other software guys, they are the first to get impacted. So you have to be a little more than just plain vanilla software companies, and AI can do most of the basic work. But it's not just going to go away. It's going to take a different form. They have to innovate. They have to improvise, the software companies. But the whole software complex, on the face of it, anyone that is that can be that's a data company or any data generator, that AI can do it easily, that's going to get impacted. So you saw Gartner on one side, you got Facebook on the other data aggregators, rather Reuters and all that. So you're going to see a lot of that impact. That's a knee-jerk reaction. But let the dust settle, then you're going to start seeing some winners and losers. But on the face of it, it's a big hit. If AI can do everything, it cuts down on manpower. And the bigger thing, that the spillover effect is that when the layoffs happen, if the software is going, if they don't need that many people, layoffs start happening, then there are less seats that the software companies can sell into. So the demand gets impacted. So there's like a lot of domino effect of AI that you're going to see more and more of. So I think that's what the market is worried. They want to sell it and then shoot first and then think later. You know, that's what's happening right now.
Yeah, well, appreciate it, Santosh. Tricky times right now. Santosh Rao, their head of research at Manhattan Venture Partners.